Everyone is talking about a soft landing. Turn on the TV, open the financial papers, and you'll see the same headline repeated over and over again. The Federal Reserve has beaten inflation. The economy is strong, and everything is going back to normal. It's a comforting story. It's exactly what they want you to believe. But if you look at the raw data, the numbers they don, T talk about on the evening news, you realize that this silence isn't peace. It's the deep breath before the plunge. The reality is that the Federal Reserve isn't fixing the economy. They are setting the stage for a controlled demolition. The math of the U.S. debt market, combined with the fragility of the banking system, suggests that a crash isn't just an accident waiting to happen. It is a requirement. To reset the system, they need asset prices to fall. They need a crisis to justify what comes next, the biggest money-printing event in human history. And if you aren't paying attention to the specific mechanisms they are dismantling right now, you are going to be part of the collateral damage. But before we expose the mechanics of this crash, I need you to smash that subscribe button. We are talking about life-changing financial shifts here, the kind of information that separates the wealthy from the wiped out. Make sure you resubscribed so you don't miss the signal when the noise gets too loud. Now, let's look at the first domino. It started with a silent deadline that most people missed. In March 2024, the Federal Reserve quietly ended the Bank Term Funding Program, or BTFP. Unless you're deep in the financial weeds, you probably forgot this program even existed. But back in 2023, when Silicon Valley Bank and Signature Bank collapsed overnight, the BTFP was the emergency life support that stopped the entire U.S. banking system from flatlining. It allowed banks to take their underwater bonds assets that had lost huge amounts of value because of high interest rates and swap them with the Fed for cash at full face value. It was fake money covering up real losses. For a year, that program hid the fact that hundreds of U.S. banks are technically insolvent. But as of March, that safety net is gone. The Fed ripped the Band-Aid off. Now, banks are sitting on hundreds of billions of dollars in unrealized losses, and they have nowhere to hide them. Why would the Fed remove the safety net if the danger hasn't passed? Because they are tightening the screws. They know that without that liquidity, the weakest banks will begin to falter again. This is the first step in engineering a crisis. You remove the supports and wait for gravity to do the rest. But that wasn't the whole story. While the banks are dealing with their internal wounds, there is an external bomb waiting to go off. And the Federal Reserve knows exactly when it detonates. We need to talk about commercial real estate. You've seen the empty office buildings in your city. You've heard about work from home changing the landscape. But the financial reality is much darker. Small and mid-sized regional banks hold the vast majority of the debt on these commercial buildings. These are the same banks that just lost their BTFP Lifeline. Now, they are holding loans on buildings that are worth half of what they were 3 years ago. The Fed isn't blind to this. In fact, in their own stress test scenarios for 2025 and 2026, they are modeling a severe collapse in commercial real estate prices, upwards of 40%. When the regulator tells you they are testing for a 40% drop, they are telling you what they expect to happen. They are preparing the narrative. If property values plummet, the collateral backing those bank loans evaporates. The banks call in the loans, the developers can't pay, and the bank seizes an asset that is worth less than the paper it's printed on. This creates a liquidity crunch that makes the 2008 housing crisis look like a dress rehearsal. In 2008, it was residential homes. Today, it's skyscrapers and shopping malls. The scale of the leverage is massive. By keeping interest rates higher for longer, the Fed is ensuring that when these commercial loans come due for refinancing, the borrowers will default. It is a mathematical certainty. They are squeezing the oxygen out of the room, and the first victims will be the regional banks. And what happens next would shock everyone who thinks the government is a unified front. There's a political war happening in the shadows between the Federal Reserve and the political class. Specifically figures like Donald Trump and his economic advisors. The Federal Reserve is supposed to be independent, but we all know that is a polite fiction. Jerome Powell is under immense pressure. On one side, he has a mandate to kill inflation. On the other side, he has politicians who know that a recession destroys their approval ratings. Trump has been vocal about this, criticizing Powell's timing and suggesting that the Fed plays politics with interest rates. The rumor mill in Washington is buzzing with speculation that Trump, if he regains full control or influence, wants to curtail the Fed's independence or replace Powell with someone who will turn the money printer back on immediately. This creates a dangerous game of chicken. If the Fed crashes the economy now, before a political transition is fully cemented, they can blame the business cycle. If they wait, they get blamed for the crash. This political tension adds a layer of volatility we haven't seen in decades. It means the Fed put, the idea that the Fed will always step in to save the stock market, might not be there this time. Or at least not until it's too late. Powell might be willing to let the market burn to prove a point about inflation, or to force the government to cut its spending. They are playing poker with your retirement accounts, and the stakes are the U.S. sovereign debt market. Speaking of debt, we have to look at the smart money. While the average retail investor is buying the top of the S&P 500, the whales are doing something very different. Look at Michael Saylor. Saylor and MicroStrategy aren't acting like a typical tech company. They are acting like a desperate survivor on a sinking ship. Saylor is issuing debt-borrowing fiat currency to buy Bitcoin. Why? Because he understands the endgame. He knows that the Fed is engineering a crash not because they want to destroy the economy, but because they have to save the Treasury market. Here is the logic. The U.S. government is $35 trillion in debt. The interest payments on that debt are exploding. The only way the government can pay those debts is to print more money. But they can't just print money when inflation is still sticky. That leads to hyperinflation. So, the engineered crash theory suggests they must first induce a deflationary crash. They need asset prices to tank. They need a recession. Why? Because a recession kills inflation. Once inflation is dead and the economy is screaming in pain, then and only then can they turn the money printer back on to save us. Saylor sees this. He knows the crash is the precursor to the printing. He is front-running the inevitable devaluation of the dollar. He has betting that when the Fed finally pivots to save the banks and the real estate market, the flood of new money will send hard assets like Bitcoin to the moon, while cash savers get inflated into poverty. This brings us to the mechanism of the crash itself. It's not just about interest rates. It's about liquidity. There is a facility called the reverse repo market. For a long time, this was a slosh bucket of excess cash that kept the markets lubricated. But that bucket is being drained. When it hits zero, the shock absorbers are gone. At the same time, the U.S. Treasury is flooding the market with new bonds to fund the government's deficit. Supply is up. Demand is shaky. If the bond market has a hiccup, if there are no buyers for used debt, yields spike. If yields spike, everything breaks. Stocks, real estate, banks. The Fed is walking a tightrope. They are trying to drain the excess liquidity without crashing the system, but history shows they always miss. They always tighten until something snaps. In 2018, they tried to tighten, and the market crashed by Christmas. In 2020, the repo market broke, and they had to print trillions. Now the setup is even worse. The leverage is higher, and the geopolitics are more unstable. So, how does this play out? You need to watch for the credit event. It won't be a slow decline. It will be a sudden freeze. One morning, a major regional bank will fail to open. Or a massive real estate developer will default on a billion-dollar bond. Panic will spread instantly. The algorithms will sell. The soft landing narrative will vanish in seconds. The media will call it a black swan, an unpredictable event. But you will know better. You will know it was the inevitable result of ending the BTFP, ignoring the commercial real estate rot, and trapping the economy in a debt spiral. But here's the most important part. The crash is not the end. The crash is the transfer mechanism. In every financial crisis, wealth is not destroyed, it is transferred. It moves from the hands of the panic sellers to the hands of the patient buyers. It moves from those holding paper promises to those holding hard assets. The Fed is engineering a reset because the current path is mathematically impossible. They cannot sustain this debt at these interest rates. Something has to give. When it breaks, the reaction from the Fed will be swift. They will pivot. They will cut rates to zero. They will restart quantitative easing. They will buy the bad debt from the banks. They will do everything they promised they wouldn't do. And that is when the real inflation starts. That is when the dollar loses its purchasing power for good. The people who win are the ones who are positioned for the pivot before the crash happens. This is why people like Saylor are relentless. They aren't afraid of the volatility. They are afraid of the certainty of the dollar's collapse. So, what should you do? First, stop listening to the soft landing propaganda. Look at the data. Look at the bank balance sheets. Look at the insider selling. Second, educate yourself on hard assets. Whether it's Bitcoin, gold, or strategic real estate, you need to be outside the blast radius of the banking system when the dominoes fall. The Fed is playing a dangerous game, and they are gambling with your future. They are trying to engineer a controlled demolition, but in a system this complex, control is an illusion. The crash is coming. The only question is, will you be a victim of their engineering, or will you use it to build your own financial freedom? If you found this breakdown valuable, you need to join our community. Hit the like button to help this video survive the algorithm, and leave a comment below. Do you think the Fed will pivot before the election, or are they going to let it burn? I read every comment. And don't forget to subscribe. We are going to be tracking this crisis every single week, and you cannot afford to look away.